Welcome to Stockwatch with me, Ray White. So joining me to unpack your stock-related questions today are Gary Booysen from Rand Swiss and also Graeme Körner from the Körner Perspective. Be sure to send your questions, though, through via email to stockwatch@bdtv.co.za, via SMS on 41392, or on X @BusinessDayTV using the hashtag Stockwatch. Right, Gary, I want to start with you. Graeme, I'll get to you now. And let's be honest, it's been quite a week. A terrible Tuesday, we can call it that. I've got so many questions. In fact, I'm just going to climb right into it, Gary. First question is, where do I put my money? Do I hold my position? I think it's such a good question.
that's about the time we start getting questions like that. And I mean, I think the simple answer is, how are you approaching markets? And kind of, I suppose, from a psychology point of view, is if you're going to panic quickly and panic first. Otherwise, understand that you're in this for the long run. You're going to be able to ride through whatever volatility, and you I suppose, need to be able to understand that if you're exposed to equity markets, if you're sitting, with a long tech portfolio, or you're sitting, long S&P 500 or something like that, there could be material drawdowns. If this conflict in Iran, expands across the region, the Straits of Hormuz are effectively closed. If they stay closed for a significant period of time, we can go well above $100 a barrel in oil. We've seen this movie before. We saw a supply shock coming in, when the Russia-Ukraine war started in 2022. The equity market response to that was to grind lower for 12 months, eventually ending the S&P 500 20% down. And if you look at time value of money calculations, you kind of adjust for inflation, where the oil price used to trade even kind of, between 2000 2010, we can see sustained significantly higher oil prices, well above $100 a barrel, which is going to take put a lot of pressure on central banks in terms of what they can do, in terms of cutting interest rates. It's going to put a lot of pressure on equity markets, and you need to be able to ride through that. If you can't ride through that, I suggest panicking today.
Whew, okay. I mean, Graeme, are you panicking at the moment? Are your clients panicking, or is it? Gary, you're quite right. This is not our first rodeo. I don't know. Where do you see things?
I think, Ray, coming into this week, our market had a good run. Obviously, golds and plats were the star performers, but generally our market had been strong. World markets were looking good. Although if you look in the US, for example, software companies and some of the other tech companies, those that all platforms that were seen to be vulnerable to AI disruption, had been taking a caning. So I think markets were maybe a little ahead of themselves in some places. So that was the backdrop. I think for me, I think Gary's right. If you're going to panic, you probably wanted to panic first thing on Monday morning rather than waiting for now. But for me, the reality is you have to now say, well, what am I trying to do? If I'm fundamentally a long-term investor and I'm essentially invested, you say, what, as Gary said, the equity markets give and they take in mark to market, but the reality is until you cash in, it's all just noise. It's the old weighing and voting machine analogy of Donald Trump. So I think if you've got great companies that have taken a 5 or a 10% hit, I wouldn't worry about them, particularly if you look, for example, at South African financials. Even after the correction, they're still up very nicely. And if you're in gold and platinum, you're still smiling all the way to the bank, unless you bought them on Friday. But even then, so I think for me, I don't see this as a cause for panic. I agree with Gary that oil could upset the party. Everybody was sort of penciling in 2 rate cuts in SA 2-3 in the US. If this, if Brent remains above 80 for a few weeks, it could introduce a little bit of inflation. But my sense is, I don't want to be penciling or penning in, oil at 85, 90 or 100 just yet. I think we need to see how this thing plays out, because I do feel that, it was a bit of shock and awe. But I would imagine that that logic will prevail and that you will see a de-escalation over the coming weeks. So, and I mean, I don't know if you saw Trump overnight was issuing instructions to insurers and some of the agencies there, and the U.S. Navy to, secure oil flowing through the strait, etc. Which whether they can do it or not is another matter. But I do feel that there's pressure on the Trump administration to try and de-escalate and just bring markets back into some sense of calm.
Yeah. What worries me a lot, Gary, is that Trump has bitten off more than he can chew. And Putin did the same thing. I mean, that 2-day war that Putin had organized for Ukraine is now 4 years in. If we do see a sustained attack and back and forth and back and forth, what happened after Ukraine? I suppose everything settled back anyway, and we just got used to that scenario. What are your thoughts?
You get used to that scenario, but it takes a long time for trade flows and trade patterns to shift. So you remember, one of the big supply shocks coming out of Ukraine was through wheat prices as well. And until we had that wheat able to be exported through the Black Sea, we were facing significantly higher inflation figures. I mean, soft commodity prices around the world, because it's not just wheat that spikes; it's all the substitute products as well. As trade patterns shift, and I mean, arguably, closing the Persian Gulf is a far greater supply shock. I mean, we're talking about 20% of the world's oil moves through here. And to Graeme's point, Trump has obviously been speaking about, the US military escorting ships through the strait. The problem is that, this is to your point, quite a complex battle that they've gotten themselves involved in that, US nuclear submarines can't move into the Persian Gulf, but Iranian diesel-powered submarines can sit on the floor of the Gulf and take out ships. I mean, we saw it in kind of the conflict in the 1980s. This can be closed for a long time, and I think with the 12-day war, following the 12-day war, there's been I suppose a decentralization of Iranian military leadership as well, which means that even though Israel has now I suppose said that they will kill any leader that Iran selects, the military is operating essentially independently. So you can see, to your point of have they bitten off a little bit more than they can chew. I think there could be a significant disruption, and we're seeing it. Already oil tankers are full and they can't move out of the strait. So Qatar has had to shut down production. Iraq has had to shut down production. Saudi is shutting down production. This is why we've got the oil price at 85. And I feel that at this stage, unless there can be a walk back, this is justified. And I would say higher oil prices are justified from here as well. I think maybe, a glimmer of hope is that the objectives around the campaign by the White House have been very obscure. It's been everything from prevent Iran from getting a nuclear weapon to, destroy ballistic missile sites to regime change. There's a lot of things being spoken about. And because the objectives are so obscure, it's quite easy to see Trump unwinding that, almost claiming victory without actually needing to meet any material objectives of achieving a regime change. And if that's the case, then of course everything unwinds. The whole region settles down, and we see a very rapid, resolution of the conflict. But I wouldn't make that my base case at this stage. I think this is fairly serious.
Yeah, but I mean, looking at Brent crude oil going north of $80 a barrel, and like you said, could go up. Graeme, you spoke about that. You spoke about the fact that interest rates, I wouldn't think that any Reserve Bank governor right now would be going, let's drop our rates. I think the entire world will either wait, see what happens, or go north and go up. I don't know. It's such a strange scenario. The whole earth, the whole world just changed on Saturday.
Yeah, I think it obviously varies from country to country. So I think quite frustrating for South Africa, where, my sense was there's been a window of opportunity for us to rebase our rates. But I think the SARB, as always, will be very cautious, even though we're actually quite close to that new target, and there were actually before some disinflationary pressures. In the US, I think it's a slightly different story. They're targeting 2, and inflation is stubbornly sitting above 2.5. And something like this, even if it only adds another 20 basis points to inflation, it does have a multiplier effect and a second round effect as well. So my sense is exactly as you're saying. While these conditions persist, I can't see any central bank cutting. But I think generally we've had our rate decisions, so we've probably got a few weeks to hopefully see settling down in oil markets. But I would imagine they'll be very much maybe a little less data driven and worrying a little bit more about their base case assumptions around things like oil prices. So even if they would have, on balance of argument, said we forecast inflation to be at 3.2, and that gives us scope, my sense is they'll probably pause.
Yeah. What's happening with gold now? Because we had $5,300, I think it was Monday, then $5,100. I would have thought it's a safe haven. I would have thought it would just carry on shooting up, shooting up, shooting up. Gary, you're smiling there because no, it hasn't done that. Right, I'm not sure if Gary's frozen there. Right, Graeme, I think he's frozen. I'm going to throw it back let me throw it back at you quickly.
Yeah, you and me both. That the markets are a wonderfully humbling place because, if you sort of said, well, the cocktail remains good, you would expect gold to power ahead to new highs, but it didn't happen.
Yeah, okay, right. We've got you back there. Gary, I mean, gold, like you can see right there, I would have thought it would hit like $6,000 a barrel, an ounce rather, but I'm totally wrong in this, and I'm also humbled today. What are your thoughts?
I mean, it's a very, very interesting point. And I think there was a lot of head scratching yesterday when we had the gold miners, kind of heading towards 10% down. And really, for me, it was a resurgence in the US dollar. So, the US dollar hasn't really behaved like a safe haven asset for the last for the last little while. It's been, almost buffeted by risk on, risk off trade, like almost like the South African rand. And with everyone rushing back to dollars, and again, it's difficult to tell why the dollar trade was so prevalent. But that's one of the reasons that you saw the currency. I mean, our lows yesterday on the rand dollar pair were like 16.04, moved out all the way to 16.75, and at the same time we saw significant selling in the dollar gold price. But if you look at the rand gold price, you can look at something like New Gold, the Aspen New Gold ETF as a proxy for that. You'll see we did pull back, but it was very slight yesterday. If you price Krugerrands, I mean, an ounce of gold was sitting probably like 91,000 on Monday. You're sitting at about 87,000 at the moment. So it's not a significant move in rand terms, and for me it was all about dollar strength, and maybe it's a reminder, when everyone goes, what's backing the dollar, it's got this big debt problem. I mean, the Iranian conflict has been a stark reminder that it's the US military backing the dollar, and the US military is pretty significant.
Yeah, all right, let's park it there for a minute. We've set the scene quite nicely. Sarath Kalangi says, looking at IOCO, their share price prospects, my average price is R3.37, with the current levels at R4.30. If I hold for another 4 years, is it a good investment? Looking at IOCO. Right, Gary, we're going to start with you.
I don't look at IOCO, which is, I suppose, the old EOH, in a lot of detail. It's a fairly small counter. The liquidity is not great on it, and I'd hesitate to give a 4-month view. So, I mean, from my perspective, I mean, we all know the kind of governance failures that happened around EOH, and this is a late stage turnaround story. If you look at the trading updates, for the end of the 6 months to the end of Jan, it was good. I mean, earnings per share, headline earnings per share up 27 to 30 cents. So that's an increase of between 42 and 48%. And like I said, late stage turnaround. It does seem like the business is gaining ground, and certainly from a profitability point of view, the turnaround seems to be taking hold. As I said, I think that the industry that it's operating in as like an ICT partner and reseller, the old kind of like business under Asher Bobbitt was really to go out and use the EOH reputation to find smaller ICT players, offering them shares in EOH, bringing those people into the group, kind of like leveraging the economy of scale and growing from there. So the governance failures, I mean, left them with serious reputational damage, and I think it's a very different business today, but it's also a business that's operating in a sector that is ripe for disruption. I mean, we saw how software as a service companies got hammered in January, after the release of the Anthropic tools, and kind of the market almost saying everything from Adobe to CRM, anything that has to do with ICT and certainly software as a service is not worth owning. It's all going to zero because we're all going to build our own things with AI. So I think it's in a disruptive sector. sector. I think obviously, their business is very different because it's more an implementation business. But yeah, I don't know so much on the valuation. I'd be hesitant to kind of give a price target over 4 years.
Yeah, all right, Graeme. I mean, yes, you're right. I mean, Gary's quite right. EOH, they were in the news for the wrong headlines. They really, it comes from a very bad backdrop. But we've got IOCO. What are your thoughts, Graeme?
Yeah, I think Stephen van Coller, when he was the CEO, I think truthfully it was not, he had no idea how bad it was. But I think between him and the new leadership, they've definitely cleaned it up. I think they seem to be very much on the front foot, actually looking for acquisitions after obviously having to shed quite a lot and getting the balance sheet right. So I think a slightly different view from Gary. I do think that there are businesses that are vulnerable to disruption, but I think also, corporates, which is essentially their bread and butter, they're still going to need those technology solutions. And if you just look, for example, at the banking sector, there's going to be continued massive investment into IT. And I would imagine somebody like IOCO would be a beneficiary of that. So I think it is a competitive world. There are parts of the business that are probably vulnerable, but it's actually looking for somebody who's got appetite for this kind of small cap and risk. I think it's looking quite interesting.
Yeah. Right, Graeme, let's stay with you. Brian is talking about Prosus. Appears to be on a 52-week low. What should I do next? Now, Prosus, Naspers, everyone's favorites. It's a 52-week low. I would say buy, but what would you say, Graeme?
Yeah, I agree. I think it's a buy. We've been adding over the last couple of weeks. It's been quite nice to see it coming off because we're adding, obviously, for a lot of investors that had quite big weightings in this, because obviously it is still a big index. Well, the combination is still quite a big index component. I mean, if you look over 5 years, if memory serves, I looked the other day, and Tencent is actually down over 5 years, and that's the backdrop. And I think it's a combination of things. I think the market a little bit worried that some of the Tencent business models are vulnerable to disruption. I think there's also a sense that maybe Tencent themselves are a little bit behind the curve from an AI point of view. But it's exactly what Gary was saying. If the market thinks you haven't got the right AI positioning, then they've been absolutely brutal. But I think at its core, Tencent is still a good business. It's very, very well placed. It's very well integrated into the Chinese digital ecosystem. And obviously, Naspers and Prosus give you discount entry points into it. So I think the narrative hasn't changed awfully much. I think it's still definitely worth adding Prosus and Naspers to your portfolio now.
Yeah. Gary, I'll bet you my lunch that you've got Prosus in your portfolio. Your thoughts?
Of course, as Graeme says, such a large component of the index, and so I think it's less about trying to hug index or anything like that, but it's more about it offers such a unique investment pathway in the South African market. So if you look at trying to capture, and AI is one of our core themes. We run an international portfolio entirely based on investments in Jensen Huang's five layer cake, 5-tiered layer cake. So I mean, it's well within the sector that we like. We think that there should be a tailwind to something like Tencent. And for South African investors that are sitting on the local exchange, what else do you really have that is credible and at the scale that is required to make a difference? And Tencent, via Prosus or Naspers is definitely a decent avenue to explore. I think Graeme touched on a lot of the reasons that we like it as well. But I think maybe just one other point to bring up, and maybe what has pulled it back as much as it has, is I think there is a lot of concern just around rising tension between the US and China and regulation around the Tencent businesses, specifically their gaming businesses, what will be offered globally and what will have to stay in China. And I think that's maybe taking a little bit of a shine off it. But and then of course it's also going to be buffeted because it essentially is an emerging market player rather than a developed market player. When you do have a move towards safe haven assets, you tend to see Chinese equities getting sold off, which does put pressure on something like Tencent. But yeah, if you look at the technicals, I mean, right back at a long-term support. I mean, you could argue that it's just broken below that support, and traders might be saying that's a negative sign. But I mean, heading back to the 200-day moving average, obviously looks a lot more exciting than it did mid-year last year when we were hitting record highs. And I think a company that should, in my opinion, be part of a South African equity portfolio's long-term strategy, you're getting in at a nice discount. So yeah. Happy to buy it.
There we go. Happiness it is. All right, next up, Aspen. This is from Anonymous. Aspen has Canadian plans. Should I hold on to my investment? What's happening, Graeme, do you think, with Aspen? It looks positive. What are your thoughts?
Ray, that's the bottom line with Aspen. It always looks positive, and then there's always an explanation about what went wrong, and the R1 billion lost because of the contract. And I think that's the reality of it. It for some people, it's been what Buffett and Munger used to call the too hard box, where you just can't get your head around it. Too many moving parts. I'm starting to get the sense that is it. Obviously, Stephen and company were very, very optimistic about the GLP, semaglutide opportunity. I think the sale of the APAC ex-Asia, ex-China business will leave them effectively debt-free. Although the earnings will be reset lower, management seem quite confident they can get back to kind of a $9.5 billion EBITDA number over the next 2 financial years. So my sense is that if you buy the story, if you're drinking the Kool-Aid, it looks like a very interesting story. But I think more and more people have actually just been disappointed by this one for too many times. So I think what I heard this morning on the call was optimistic and positive. If you want to bet on weight loss diabetes drugs, then this could be an interesting play. And Canada's but one market, because obviously those patents are expiring there. It's one of the bigger markets where they're going first. So there are opportunities, and I think they're quite optimistic that they've got, let's call it, early positioning advantage. But I think there was a time when Aspen was considered a blue chip. I think for many people it's not that anymore. It's just been disappointing too often. But I do think, having said all of that, if you're a punter and you believe in the opportunity to exploit in a positive way this GLP glutide market, it could be an interesting one. But prepared for a bumpy ride.
All right, let's park Aspen then. Right, Gary, your stock pick. What are you looking at the moment?
Oh, I was going to say Aspen. Looking at my stock pick, I'm going very cautious. As you can see, I'm kind of quite concerned about the geopolitical issues that we're seeing at the moment. So it's quite simple. Cash is also a position. So, we've had the US dollar under an enormous amount of pressure over the last year, and we've started to see a blip. We've seen the dollar index starting to move up. Rand dollar exchange rate has sat, kind of around 16, below 16. We've had kind of a technical reversal on that. And I would say after the budget speech, where suddenly your single discretionary allowance has moved from 1 million to 2 million, this might be an opportunity to go and buy some US dollars. So not really a stock pick so much as a cash position. Get that cash ready, because I do think the buying opportunity is coming. I don't think it's quite here yet. But I think use that position to pick up some US dollars, park them in an offshore account somewhere, and just wait for a nice entry if markets get truly rattled. If we see the VIX spiking up to sort of 50, 60 and stocks coming off another 10, 15%, those are the dollars you're going to use to go shopping.
All this volatility. All right, Graeme, where are you hanging your hat this evening?
I'm going to go for something that's, I suppose, a little out of character, and that's Netflix. Obviously when they were looking at making that acquisition, it was going to change the nature of the beast quite significantly, and we've gone from being a debt-free, highly cash generative business. That was a little bit scary, but I think it's a great cash generator. I think the fears of over platforms and the impact on business models like Netflix, I think, are completely overstated. So it's obviously bounced after the news that they're out of the race, but I still think it's a good business model, and having content is a powerful moat.
Was that a worry factor though for them anyway? I mean, that's a lot of money they were about to go and invest in Discovery Warner Brothers. I think perhaps for them it's a bit of a relief.
Yeah, and I think for shareholders as well, because as I say, it went from being low capex, high visibility, no debt, strong cash flow, suddenly, the exact opposite. So, if you were a betting person, you might have said, well, the odds were actually going away from where it was very much in their favor just before, Paramount obviously got it. If you were a betting person, you could have taken a position, but it was kind of a binary bet. But now I still think it's a really good business model. And I do think they've got a lot of pricing power.
Yeah.
So I agree with you. I think apart from the financials, my sense was, if you put the two businesses together, you would not be able to charge, $15 or $20 simply because you've expanded the content.
Yeah.
So there would have been some margin compression there. So I think they're better to not have done the deal, and I think there's a nice break free as well. So happy days all around.
Yeah. Gary, Graeme, thanks to both of you. We do appreciate you taking the time to join us on Stockwatch. Thanks to both of you. And thanks to our guest, Gary Booysen from Rand Swiss and Graeme Körner from the Körner Perspective. That's all for Stockwatch today. Don't forget to tune in tomorrow, the 5th of March at 11 a.m. as we'll be bringing you the live presentation of First Rand's interim results. Up next, the close.